Hi, this is Coco Chen.
Hey, this is Harrison.
Today we're presenting the restructuring case on Cumulus Media. So to start off, Cumulus Media is a US audio-first media company that operates roughly 395 radio stations across 84 markets. It's essentially a two-sided platform that connects advertisers and listeners. On one side, listeners would engage with free local and national content, and on the other, advertisers pay for commercial airtime or digital ad placements across podcasts and streaming channels. And broadly, Cumulus generates about 65% of its revenue from traditional broadcast radio, 20% from digital, and very little from other network services. Its flagship brands include well-known names such as The Bob and Tom Show, Westwood One, and The Jim Rome Show. That said, while it's one of the larger players in the US radio space, the industry itself is in secular decline. Ad dollars are shifting away from more terrestrial radio toward digital and streaming platforms such as Spotify and YouTube. So even though Cumulus has been trying to diversify and grow its digital business, its revenue base remains structurally challenged. And the market clearly reflects this. The company currently was delisted from Nasdaq, and the stock now trades at around 10 cents, implying an equity value of roughly 2 million on a 400 million enterprise value base. That means nearly all of the value sits only with creditors. Operationally, we can see margins keep compressing. SG&A and content costs together make up over 80% of total operating costs. And move on to the situation. The company's current distress stems from three layers: macro, the secular decline we mentioned earlier, the operational issue. The company is currently underperformed than the industry average, and it's very rigid cost base with inefficiency in capex. And earlier, there are significant partners that have been collaborating with them, Daily Wire and Dan Bongino, in terminated contract. Financially speaking, the most important problem is the ongoing cash burn, which we'll bring up later again, and other issues such as heavy leverage, tight liquidity, and more restricted covenants that limit refinancing flexibility, as well as the refinancing wall that comes in 2029 with 95% of their debt. They tried earlier to have more relief, such as selling non-core real estate assets in Nashville and New Mexico, but those only provided temporary support. And their path to distress actually came a while ago. In 2027, they went through restructuring, and since then, they've been trying to do post-reorg deleveraging and paying back debt. However, the secular tailwind really hit them in 2023, and they've been under significant liquidity and leverage strain since then.
Right. Before diving into valuation, I do want to start with how Cumulus's capital structure is structured and what is driving the distress dynamics. So to begin with, Cumulus carries about $875 million of total debt, of which roughly 97% of it is first lien secured. The first lien debt includes the 2020 revolver, term loan, senior notes. The term loan and the senior notes are all both trading in the low 30s, reflecting a deep distress and reflecting that it's trading towards recovery. In the capital structure, only $24 million is unsecured. Those are the holdouts notes owners from the previous exchange. The first lien facilities are fully collateralized by nearly all operating assets Cumulus owns, including FCC licenses as well as real estate, meaning that recovery for these junior level creditors is minimal. So from a recovery waterfall perspective, this is essentially a one tranche story dominated by first liens. Like Coco mentioned, maturity is light in the near term. We only have $24 million coming due in 2026, while 95% of its total debt matures in 2029. So overall, on the right as well, we've mapped the organizational structure of Cumulus as well, as a holdco with Cumulus Media New Holdings as a primary borrower. Key assets like Cumulus Radio as well as Westwood One sits at the operating level, and they're fully pledged to first lien creditors, reinforcing the creditors' control in a lot of these restructuring scenarios.
Yeah. And going on to the business plan, our immediate objective is very clear: to stop the cash burn, to restore breathing room for operation and for long-term balance sheet fix. And working backwards from today's numbers, the company must close a roughly 70 million annual cash deficit. And that's achievable through a combination of 25 to 30 million of EBITDA improvement from cost control and digital growth, 10 to 15 million of capex savings through reallocation to digital, and 5 to 10 million of interest savings via selective asset sales. And if well executed, Cumulus could reach 70 to 75 million in normalized EBITDA, which is just enough to return to break-even free cash flow by next year. And the plan centers on expanding the digital and podcast segment, which currently makes up about 22% of their revenue. And we aim to lift that to 30% by 2027 by specifically signing stronger podcast talent and growing listener monetization, using dynamic ad insertion to raise engagement, and consolidating sales operations across radio and digital platforms to improve yield. At the same time, CapEx will be refocused from tower upgrades toward more ad tech, analytics, and content infrastructure, which carry better return on investment.
Now moving on to valuations. So we started off by producing a pure comparable set, including iHeartMedia, Nexstar, SiriusXM, and Tegna as public comparables for Cumulus Media. These radio companies trade around 1.8 times EV over revenue and 8.1 times EV over EBITDA. But after applying a distress discount of roughly 60 to 70% to reflect Cumulus's leverage, which is currently around 17.5 times, as well as its continuous operational decline, we get an implied EV range of 350 to 450 million dollars. Coco, if you don't mind, just quickly scroll to the public comps page. So this is our public comps model. Now, next, the DCF. Do you mind scrolling to the DCF? Yes, thank you. Next, the DCF was built using a 32% WACC, which reflects Cumulus's very volatile stage and as estimated by FactSet. We also implied an 8 times exit multiple, which is conservative, and then we pulled that from public comps, but in line with those small cap distressed broadcasters. So the DCF model yields an EV range of around 320 to 450 million dollars, which centers around 385 million dollars. We applied a 30% weighting here, given the uncertainty in terminal cash flow and the difficulty in predicting it. Lastly, we have the present transactions. Looking at recent media transactions, notably the Nexstar Tegna acquisition, which is valued at EV over EBITDA around 7 times, as well as Odyssey's Chapter 11 reorg, which is valued closer to 5 times. The blended sector multiple here, we chose about 6 times EV over EBITDA. So we apply that to Cumulus's normalized EBITDA, which gives an EV range of 280 to 380 million dollars, or roughly 325 million dollars on weighted value. Lastly, we also model a downside liquidation scenario, assuming recovery from real estate, lease assets, and limited value from intangibles. The distributable EV comes in between 250 to 280 million dollars, which is the floor. These scenarios fully support the idea that the equity recovery here is an unlikely story for Cumulus. When we equal weight across all 4 methods, the blended implied EV range converges to around 385 to 390 million dollars, or roughly a 350 to 400 million dollars in range. That is broadly consistent with where distressed media credits are currently trading in the secondary market. Overall, Cumulus's equity remains deeply out of money, and any recovery would depend on the creditor's recoveries through its Section 363 sale rather than a standalone operational turnaround.
So here we evaluate 3 paths forward for management. The first option would be asset-backed bridge financing. So Cumulus could continue monetizing its non-core assets, like the 10.5 million Nashville property or 2 million New Mexico land sale, and pursue limited tower sale leasebacks for short-term liquidity. However, any new financing beyond permanent baskets will require lender consent, and with declining EBITDA, it's unlikely the market will lend against this collateral. So this path, we think, may buy a few months of liquidity, but eventually it only serves as short-term bridge and will never solve the balance sheet problem.
Our second option is a strategic sale or a merger, which is the medium-term option. So the rationale here is threefold. First of all, the industry's structural decline makes scale-driven consolidation the most viable way to capture cost synergies and maintain relevance in this industry. Second of all, there is now growing FCC deregulation momentum driven by Commissioner Brandon Carr, who's advocated for loosening ownership caps. That could allow larger players to absorb smaller peers like Cumulus. And finally, recent M&A precedents like the Technar Nexstar transaction signal that PE firms as well as strategic buyers are again willing to engage in traditional broadcast platforms. Potential acquirers we explored could include Alden Global, Chatham Asset Management, Standard General, AG Vora, as well as Soros Fund Management, all of whom have either sector experience or history in opportunistic media consolidation. Lastly, that brings us to our option 3, which is a pre-arranged Chapter 11, which is our recommended path. Given the lack of refinancing flexibility, all in-court restructuring offer the cleanest path to delever Cumulus's heavily leveraged balance sheet and protect its core assets. A pre-arranged filing would enable a balance sheet reset through a controlled Section 363 process. It could preserve value by securing tower and FCC license collateral. It could help Cumulus maintain key station clusters like Westwood One and allow operational continuity with DIP financing and creditor cooperation. The ideal timing here will be pre-2026 maturities, once liquidity exhaustion becomes critical to maximize leverage in negotiations. In summary, Cumulus's persistent cash burn and covenant rigidity leaves very little room for out-of-court fixes. We also conducted a thorough doc spread to prove that this would only offer temporary relief and not very, very hard to carry out. While selecting asset-backed sales or M&A could help extend Cumulus's runway, a pre-arranged Chapter 11 is more favorable because it will help reset capital structure and preserve long-term franchise value. Thank you.
Thank you.